Good afternoon. This is Ken Long at Tortoise Capital with the review of the weekend trading report for April 21st, 2018. The market is in bullish normal conditions. On an annual basis, using weekly RSI 14, we're right in the middle of neutral at 51 out of 100. On a 10-day basis, using the NDX 10, we're also in the middle of neutral at 59 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is red bullish at 2.39%, so just above the threshold for sideways. The slope of the 50 has improved slightly to yellow neutral at 0.07. ADX is a non-trending 21.1. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. The current reading is at 1.098, so we are into risk on. Take that score and look at the last 5,000 trading days. We compute the risk Z by finding the average and standard deviation of the look-back period, and we compute the risk Z, which comes out at 1.0. So we are one standard deviation above the long-term average for the risk index. You can see the holdings in the blended monthly rebalancing. Next reevaluation is due on or about 1 May. And then the current leaders on the based on the closing prices on Friday. In ETF2, the theoretical exposure is at 40%. Just a quick look at the blended monthly rebalancing portfolios. You can see more than half are on cash positions, price below their 4-month moving average. Latin America and U.S. tech, only some of the few bright spots. In the Dow 30, you'll also see a mixed bag. Technology is near the top. Intel, Cisco, Nike, and Microsoft, so 3 out of the 4 are in tech. The weak areas, General Electric, Procter & Gamble, Johnson & Johnson, and DuPont. But we've been following GE for a while here. It's starting to make a change to its long-term pain and has put in a good week and a good month. So that's one that we will be looking at as a bottom feeder momentum kind of a play, sort of a washout continuation pattern, if you will. Shifting to the sector spiders now. Again, about a third of them are on a buy signal. We have some energy, healthcare, and some technology near the top. Home builders, staples, farms, real estate, treasuries, healthcare, sort of the defensive, long-term, mature industries suffering right now. I'll be looking at more follow-through in oil and gas exploration, as well as metals and mining. In the ETF Max, the volatility plays were hit this week. You're seeing some energy, oil, timber looks to be very interesting to me. Wood. Again, oil and gas, aerospace, Finland, commodities and base metals, so that reinforces that XME, metals and mining. Inside the market health check, the vertical blue lines are 10, 20, 30 days to look back, 40, 50, 60, you notice. Horizontal red lines are support levels that used to be resistance levels, and these would be price targets on the way down if price continues to collapse. The purple lines are price targets on the way up until we might reach 276 to test the previous dragon hump, and then about 284 to test the previous swing high, absolute high at about 286, but the dragon hump I treat as the realistic all-time high. Just want you to notice the power of the and usefulness of the MACD PSAR combined with the MACD histogram to find those turning points. Notice when that shifts to the downside here, it went from the trailing, and then this is where it picked up the downside pretty early, and then picked the upside again early here. Pick the downside switch over right here, and then pick the upside pretty well right there. That PSAR has been a pretty good guide for us, and then combined with the PPO or MACD histogram. This is where that the MACD crossed the zero line. The signal line crosses the 5-period moving average right here, so this is where we start getting cautiously optimistic, and with this as a bottom, you can see how that leads to a potential turnaround. Here's where that signal line enters the 1 sigma river on this indicator, where it crosses the mean, where it crosses the zero line, so this is still pretty favorable. Now we've had 2 days of pullback, which brings price back to the dragon and to the Bollinger Band mean, but still favorable, so that would place this as a successful P1. And now if this can hold support here at this level, then the next leg up will test this price resistance at 276, and if that's cleared, then it's on to 282. So market has put one leg back in. No reason to get excited yet. It still has to really get through 276 to be significant. The last time it held support here, it got to 276. It hasn't yet, so let's see where we're at. You can see the 200-period moving average has crept in. The slope of the 30 has been improving since here, but it is still at minus 0.3, so still a downward pull on the 30, and so the trend is still down, but there's reasons to be optimistic. ETF2 regional report, 4 out of the 10 regions are on buy signal, so that gives a theoretical model allocation of 40-60. The S&P at 33 is now back better than EFA at 18, which has been suffering. Inside the U.S., it's tech, then mids, then smalls, then large caps. Emerging markets and Asia less Japan have been the strongest. EFA and the S&P, the large caps have been suffering globally as well as in the U.S. Not much joy inside the sector spiders. Industrials and utilities seem to be where it's at. In the market health check, world market model here, we get U.S. is generally above average except for these blends. The other asset classes, commodities, suffering a little bit. Both Asia and Europe are a mixed bag, and so this is really a stock picker's market. Short-term wins should be exploited. Get them when you can is my advice right here. So my swing trading has shortened up to shorter time frames, been emphasizing more of the intraday and waiting for the new leaders to shake out and the world to get back to normal. ETF2, the top 30s. I like to look at the green and white as a sign of emerging strength after an above average run. So U.S. oil is doing pretty well. Switzerland, Japan dividend, 10-year treasuries, the UK. And then white and green is a signal that something that was long-term strong is starting to weaken a little bit. So emerging markets, junk bonds, home builders, and utilities starting to weaken. Again, a mixed bag. ETF liquidity based on the last 30 days of average trading volume. You can see technology is still firmly in second place. Shifting to the daily. No signals on channeling and overreaction. See the usual suspects on the 10-day max pains. Tactical summary. Really, there's a handful of symbols that test out well on the auto framer. There's a number also that test out with the RSI2. Some fraud quality numbers starting to creep in as volatility has decayed a little bit. I'm very interested in General Electric here, which has had a 1-day, 10-day, and a 1-month outperformance despite the suffering on longer term. So that one looks like a very interesting turnaround play. There may be more to that one. Among the ETFs, much the same thing. There's a couple 551Ws and some auto framers that test out well, a couple in the RSI2. But still, metals and mining, energy, oil exploration, that looks to be where swing momentum is. But again, this is a market still that we don't want to be in a hurry to get committed to. We want to look for anomalies and exploit some momentum when we can, and cash them when you get them, is my opinion. I don't see reasons to believe in these positions for too long because of the just having come out of sideways volatile conditions. This is still a fragile market. Daily pinch and stretch. These are the ones that are in the green that are more than one standard deviation above their 30-period moving average, the middle of the river. You see it dominated by energy here with XLE, XOM, Devon, Chevron, US Oil. Also, there's metals and mining, Merck, GE still doing very well along with AXP. So there's some momentum plays there. But also, if you're holding wins in these positions and after being stretched that far, this would be a natural place for them to begin to suffer a little bit. The most negative Z stretches. This is maybe a place to be looking at IBM and Apple on sale, along with technology and broader techs as well. Here we have the most expanded pinch boxes. These are the symbols that have had the most consistent directional 30-day move. That means the river is wide. The compressed pinch boxes are the ones where the river is narrow. And gold, Verizon, and Latin America all qualify as super pinches because not only is the river very narrow, but also the 10, 30, 90, and 270 regression lines are all tightly clustered, and so these are poised for breakouts. I will be framing those trades for the advanced swing trade course and posting that video for the students and discussing some strategies with that later tonight. Auto Framer offers some interesting targets. There's gold, IBM, Procter & Gamble, Johnson & Johnson. So some of the things we were looking at already are also testing out well on the Auto Framer. In the regression line fractal framework, the top shelf in the green, the symbols that are the most ATRs above their own RL270. So we treat the RL270 as long-term fair value, and these are the ones that have pushed well beyond that. And that suggests that they are strong momentum plays, and there may be some continuation patterns, or it may be time to ensure that you've preserved those gains and locked them in. McDonald's, 3M, Procter, Walmart, Johnson & Johnson. Those in the red on the bottom shelf, these are the symbols that are most, I take that all back, I'm sorry, the ATRs below their RL270. These are the ones that are undervalued according to long-term fair value. So that makes more sense now with 3M, McDonald's, Johnson & Johnson. These are value plays. In the red, these are the overheated ones. So GE, Merck, Cisco, Intel, these are the ones that are pulling ahead of their RL270. So what makes GE interesting is that now that it is above its RL270, it's still been suffering, but this turnaround has now sort of changed the long-term position on that symbol, and so this looks like a deep value play, and that's how I will be framing it later tonight. Daily squeezes, these are ones that had narrow ranges on Friday, but have been generally much more volatile, and so much like a coiled spring is ready to pop, these are ones that are available for sharp, surprising one-day moves. I like the idea that the Russell 2000, IWM, WIN, EFA, Monsanto, Gold, and Energy are all in there ready to pop along with ConocoPhillips. So there are some energy sector symbols that are ready to give us a nice one-day pop. In the advanced swing trade, I will be answering questions about that, just to give you a preview of coming attractions. As you can see, we do a weekly swing trade course FAQ, where we record the answers to these and have some discussions and follow-on lessons. Make sure everybody's getting it. We record those so that people can follow the charts and listen to the explanations. The look ahead for today, we'll be looking at how do we turn successful day trades into swing trades with markets money? How do you keep a balance of work and family when you trade from home? Can I trade just the Excel series and big indexes to learn swing trading on the regions and then apply maybe symbols later for ease of management? Yes, by the way, you can. I mentioned momentum stocks. I will be drawing a distinction between momentum and relative strength stocks because of the time frame. What do you do when you've got a price that's making an all-time high? How do you find a 2-to-1 risk reward when there's no upper limit to act as resistance? When you're looking for strong sectors to jump on, is it as simple as using 1 week and 1 month relative strength, or there's some other considerations? I'll be talking through those along with some of the questions that came out of the chat room this week that had some very good discussions that I want to highlight for the team as well. There's that self-paced swing course is always available. You have access to it even after you've completed it, because we make continuous updates to it. So you have an ongoing availability of our most current thinking on swing trades. And I think it's a really good value. Please get a hold of me if you're interested. Meanwhile, back to the reports. Shifting back to the market mosaic, you can see it almost looks like a cup and handle here, where we've put in support around 260. The slope of the 30 has started to improve. It's crossed its 10-period moving average, more than 1 SD from average, so that's often an indication of a turning point. So it's gone from pain to stable until the first leg up and an orderly pullback. So it really matters that it can hold above 265 here and put in this double bottom. There's still plenty of room above to look for the support from the 200-day moving average to recover. This was all that Trump bump gains, and then depression set in. Reality, some might say. But the steepness of the 30-period regression line is, looking at the last 10 years, there's only a half a dozen times that it's gotten that steep. After every one of those, there was a nice bounce back to the upside. So I'm optimistic about the potential where we are right now. Cautiously optimistic, as always. Volatility beginning to decline on a steady basis by both the 30-period and the 14-day period measures. Looking at the slopes of the Z-scores. Let's get this cleaned up a little bit. So the 30 has made a double bottom here, the slope, and it's coming back into the lower range of normal. The 90 has blown off all that excess foam and steam from the Trump bump and is finding support down here at the -1 sigma. The 10 has just put in, this tells us this nice little price move right here has improved the slope of the 10. This would be a natural place for it to pause. So now the question really is, can we hold the southern edge of the river and then find support to come up and test here around 276? Or is that river not going to hold? So that's sort of the question where we're at. Lots of room to engineer moves, but we are definitely in band trading right now, and the shorter term time frames are rewarded in this kind of a choppy sideways market. So let's not get ahead of ourselves. Don't believe too much in this stuff. Continue to make your reward and risk trade frames. Cash them when you have an advantage, and it's better, I think, at this time to have a bird in the hand worth two in the bush. You can always re-enter. No need to be in a hurry. That's everything I want to cover for this week. This is Ken at Tortoise Capital. Keep your risk measured and powder dry.